Hey everyone, thank you for joining us on this webinar. Obviously, this is a very exciting time, as you've probably heard that Congress has decided to give a tax credit up to $5,500 to those who have a 401k plan or who are wanting to implement a 401k plan for their employees. This is probably the biggest change to the 401k industry in probably a decade. Now, most of you are watching this because you either have a 401k, like I said, or you're deciding on whether it makes sense to start one for your company. And there's also some CPAs and other benefit providers who are looking for clarification on how the Secure Act is affecting 401ks for their clients. So either way, welcome. So let's go ahead and jump in. I know you're busy and I want you to get as much information from this as possible. So what we're going to talk about today is one, what is the Secure Act? And two, what are the changes and how they affect the 401ks? And what you need to do to get one started, and then we'll jump into the Q&A section as well. So before we jump into getting the information to you, I want to introduce our leadership team. On the left is Ryan Neff. He's our president and CEO. Then we have Brian Anderson. He's our chief compliance officer. And then we have myself, Matt Ruttenberg. I'm the chief marketing officer, but I'm also the director for participant education. So first, let me give you a quick summary and background of what we mean by the term retirement plan. There are several types of plans that work differently depending on the business and the employer and what your goals are. So we have the 401k, we have the simple IRA, we also have a payroll deducted IRA, and then we have the SEP IRA. There's also something called a solo K or a solo 401k, or also a individual 401k. All the same thing, but we're going to cover that kind of under the 401k side of things. So let's go ahead and explain the amounts you can contribute towards a 401k, because that's what we're focusing on today. Think of it as an upside down 3-layer wedding cake. So the first and bottom layer is the 401k. These will allow you to contribute up to $19,500 for 2020, and then $27,000 if you're over 50 as a catch-up provision. Often, we add a profit-sharing layer on top of the 401k. This is the second layer. You can add up to $57,000 for 2020 into the profit-sharing plan. And then finally, the third layer, we call it, or is called, the cash balance plan. You have the ability to put over $300,000 pre-tax into a 401k when you add all those together. This is great for companies where the owners are getting some higher profits out of the company, and they're looking to get some tax savings on that. So we do that quite a bit. So let's go ahead and get into the old rules, the old tax credits and the old deadlines. Prior to the Secure Act passing, you could write off a flat $500 per year to offset any costs associated with the plan, which wasn't much of an incentive, as more of a bonus, a small bonus. And we'll get into how much you can actually get into now and how it's calculated shortly. And of course, if you choose to do a match, this would be a tax deduction for you as well. As far as the deadlines are concerned, if you wanted to implement a 401k plan for the year, you had to have it done by October 1st for that current year. And then there's a deadline of December 31st, and this was for if you wanted to make any employee deferrals, such as profit sharing or cash balance plan contributions. You had the deadline of December 31st. Then we had the tax filing date, which is the deadline to contribute towards profit sharing or cash balance plans. So you had to have it set up by December 31st, but you could contribute up until your tax filing date, which could be up until October. Up until this point, the SEP IRA was the only plan type that you could actually implement after the end of the year, up until the tax filing deadline. So let's go ahead and get into the new rules, which is why you're all here today anyways. To us, this is a very clear attempt by Congress to get more people to save for retirement. By giving tax credits to the employer, they are hoping that it will get them to implement and incentivize them to start a 401k, which in turn will get more people to participate towards their retirement, which is a great thing. So the key changes to the 401ks from an employer standpoint is one, increased tax credits, two, participation incentives, and the extended deadlines. So let's go ahead and talk about the increased tax credits. This can go up to $5,000, and this one is for implementing or just having the 401k in place. And this is how it's calculated. It's $250 tax credit per employee with a minimum of $500 and a maximum of $5,000. Now, keep in mind, this does not include the employer, and it does not include the highly compensated employees. Now, what is the definition of a highly compensated employee? We also call it an HCE. Basically, this is anyone who owns 5% of the company or earns over $130,000 per year. Some family members are automatically considered HCE, which would be parents, spouses, children, or grandchildren. Grandparents, siblings, and cousins are not considered highly compensated employees. So a few examples on that is if you're a solopreneur and looking to start your own 401k or individual 401k, solo K, you won't be getting any tax credits because you're the only person there. If you're a good-sized company with, say, 25 employees, and we assume they're all going to participate and none of them are considered HCE, you'll get the $5,000 tax credit. You'll max that out. Now let's go ahead and jump into the next level of tax credits, because before I mentioned $5,500 on this last slide, I was only mentioning $5,000. You're actually going to get an additional $500 tax credit if you use auto enrollment for your plan. This is for both new plans and plans that are already in force, meaning if you have a plan, you could switch it to auto enrollment to get that additional $500 tax credit. Now, what is auto enrollment? You might be asking. Automatic enrollment is where your employees will need to opt out of the plan instead of opt in, is kind of the basic explanation of that. The idea behind this is psychological. Your employees will basically need to think twice before deciding not to save for their future with hopes to get more to participate in the plan. After all, statistically, about 70% of Americans only have $1,000 in the bank. So again, that's why they're incentivizing the employers to try to get more people to save for retirement. Let's go ahead and jump into the new deadlines. This is another big change for 401ks. We already talked about what they used to be, the old rules. Now let's go ahead and talk about the new rules. You can now push out the implementation date to the day before you file your taxes, including the deadlines. Just like I mentioned, the SEP IRA was the only plan type that you could do that. Now, all 401ks can do that. This means during the busiest time of year for you, for a lot of you, which is the end of the year, you don't need to think about, oh shoot, I need to implement a 401k before the end of the year so I can get some additional tax credits. Now you can actually wait up until the day you file, including the extensions, which would put you out to October of the following year. For example, if in 2020 you have a great year and you want to start putting some money into a 401k, you don't have to start it until you file in the year 2021. Now, this starts with plans that are implemented in 2020 for the tax year of 2020. And what I mean by that is you can't use this rule for the 2019 tax year. So if you want to get a 2019 deduction, you would have had to start a 401k by December 31st of 2019. So if you're listening to this after the new year, then and you haven't started your 401k plan, you're going to have to wait to get a deduction for 2020, or a SEP IRA might be something you could think about. Give us a call because there are some rules around that which might not be beneficial for you. So there are some other changes that I wanted to run by you, and we can do these relatively quickly. They're changed to MEPS, increased penalties, and part-time employee eligibility, which we will cover one at a time here. The bad apple rule was removed to MEPS. Now, a MEP is a multiple employer plan, and this means that basically an employer could, or two or more employers could come together and create a group plan. Prior to the Secure Act, these were allowed, but if one company fell out of compliance, all the employers in that MEP had to pay the penalty. Now, with the passing of the Secure Act, every employer's liability is siloed, but this rule starts in 2021. So, for example, with that, if you had a group of employers in a MEP and one did not file their 5500 on time, then the entire plan is considered out of compliance, which means every employer would have to pay that penalty. Now, with the new Secure Act, the bad apple rule was removed, which means everybody is siloed. So as long as you, as the employer, are following the rules and staying compliant, you'll be just fine. This does not start until January 1st of 2021. So we still have till the end of the year on that. Now, why would you want to have or be a part of a MEP? The idea behind this is to lower costs and get group rates and not be hindered by the extra liability. So start thinking of groups that you're associated with, friends, other business owners, even competitors, and feel free to reach out to us so we can explain how this works. This is something that we can talk about and possibly implement in the year 2021. So the Secure Act also brought increased penalties. So this can be put into the negative category for implementing a 401k. The late filing penalty, for example, is one of those fees that will be increased as of January 1st, 2020. Filing your 5500 late is now going to be $250 per day, and it's going to be capped at $150,000. This is an increase from $25 a day and $15,000 respectively. So the increased penalties are effective, like I said, for January 1st, 2020. This change makes it very important to work with an administrator who acts as your back office and helps you with these deadlines. There are quite a few what we call robo 401ks out there that will simply send an email and it's up to you to take care of it. We will help you with these filings. We are considered an administrator, so we can help you. We file it for you, and we will run through the 5500 with you to make sure it's accurate. So the final change here is the part-time employee eligibility. So not only do you have the full-time eligibility, you now are required to have your part-time employees eligible. Now it does allow you to have two sets of rules. So you do have the full-time eligibility rule, and now you have the second set of rules for eligibility, which would include that $500 or 500 hours of service for 3 consecutive years. The reason that was added in was because they wanted to have more opportunity for employees. Maybe they have multiple jobs, multiple part-time jobs, but wanted to give them a chance to be able to save and have an easy way to save for retirement. So in summary, for the most part, the Secure Act has brought pretty favorable improvements and incentives to the 401k world and the employers of small businesses. Before, the incentives of starting a 401k plan were, for the most part, internal, meaning employers didn't get much help. All they got was the $500 tax credit, which could be considered a bonus. Now, with these new tax incentives, there's a clear mission of getting more people to save for retirement. So let's go ahead and talk about how to implement a 401k plan. And for those of you who don't have a plan in place yet, I know it sounds like a daunting task, but when you work with an administrator like Life Inc., a lot of it is taken care of for you. It's a pretty easy 3-step process. One is choosing your plan, two, choosing the record keeper, and three, enrolling the participants. And we take care of all three of those right alongside you, so it's pretty actually easy on the employer. As you can see on this piece, there are generally three parties involved in a 401k plan: the record keeper, the administrator, and the advisor who manages the investments inside of the plan. We take care of two of those three, and the last piece, the record keeper, is a decision that we actually make together because every record keeper is different and they have their own niche, and we would need to make sure that it's a good fit for you as the employer. We're your partner in all this, and we'll be with you every step of the way. We make sure that everything is in line and compliant for you. So the first step in setting up a 401k is scheduling an introduction call with one of us. We have offices in Ohio, Florida, and Maryland, and are expanding into a few more states here soon. So we'll have someone in your area to speak to. If you're still not quite ready to talk with us, or you're not quite sure if a 401k is right for your company, just head over to our retirement plan evaluator and answer a few questions to see which plan makes the most sense for you. This is something that you do on your own. It takes 30 seconds. This will at least point you in the right direction so you can start learning about that type of plan. And this actually takes care of step one that we covered in a few slides ago. So you can do that at any time. The website is at lifeincrs.com/evaluator. Okay, so let's go ahead and get into the Q&A portion where I already have a few questions here. For the most part, most of the questions are how much is my new tax credit? We got a lot of those questions from current clients, and we will walk through that with you. It's pretty straightforward, but again, it's $250 per employee that is not highly compensated and is not including yourself as the employer. But to get into the other questions, here's the first one. I have employees that have worked for us for 3 years and have over 500 hours for the year. Do I need to include them in the plan? Yes and no. You need to include them in the opportunity to save in the 401k plan, but not in receiving employer contributions. In addition, they are able to be excluded from discrimination testing, which we didn't get much into today, but feel free to jump over to our blog. We do have some blog posts on that, or you can simply ask us. Either call us or shoot us an email that I have up there on the screen, and we can explain what that means. But they are able to be excluded from the discrimination testing and the top-heavy tests. So good question. If the plan has been around for a long time and is running as intended, is it worth it to amend the plan to add auto enrollment? So this question is in reference to the additional $500 tax credit for auto enrollment. Not necessarily, unless you want to do it for the discount for that extra $500. It has been shown that employees who are more financially sound perform better at work due to being less financially stressed. So it could have other additional benefits, hopefully more than $500. But many clients we spoke with do have long-running plans that work as the employer intends, so they don't really see the $500 worth the potential headaches of changing to auto enrollment. For those of you who don't have a plan in place or are thinking of making a change, then maybe adding the auto enrollment to get that extra $500 is not a big deal because we're making changes anyway. So those were the two questions we had for the webinar. If you have any other questions, feel free to reach out at info@lifeincrs.com. Feel free to give us a call at any time. Our main number is 614-396-7652. Many of you we've already spoken to, so you have our number as well. And again, if you're not ready to chat, just head over to the evaluator. The website is right there, and you can start from there, start learning on which plan is best for you and which one is to point you in the right direction. Thank you, everyone. Have a great day, and we will talk to you soon.